Good afternoon, everyone, and welcome to Unlock the Stock with Calgro M3 and Bell Equipment, both of whom we welcome back to this platform, and thanks for joining us once again. As you know, this platform is specifically designed for investors to gain access to corporate management and to get to know them and their companies better. Unlock the Stock is only possible with our technology partner, Lumi Global, and their website is lumiglobal.com. Please visit it to learn more about their various integrated online AGM and investor presentation solutions. Our hosts, as usual today, will be the finance facilitating the Q&A in the respective breakout rooms. This event is sponsored by A2X, a stock exchange that plays an integral part in the progression of South Africa's financial markets. A2X is the second largest stock exchange in Africa as measured by market cap, with 182 securities currently listed on the platform, including 30 of the top 40 stocks, with a combined market cap of 9 trillion, which is quite something. The team at A2X is proud to be partnering with Unlock the Stock. Just as our platform unlocks value through its insights and analysis, A2X unlocks value for stocks listed on its platform and helping to drive the market forward. I'd like to welcome today Calgro M3, represented by Rech, the CEO, Sayuri Naika, the FD, and Baldi Hubert, the MD of Memorial Parks, as well as Bell Equipment. The CEO there is, of course, Leon Huesen. Before we start, a few housekeeping notes, please. Andre, if you could bring up those, that would be great if they're not already up. Each company will do a presentation of 12 minutes. You'll then see a button at the bottom of your screen to select which breakout room you'd like to join to post questions to management. Each Q&A session will be 20 minutes long. You're more than welcome to leave one room and join the other if you'd like to hear more about the other company. And please note, you'll only be allowed to post questions by typing them into the chat function at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel soon. Once in the breakout rooms, you will see an email address if you'd like to be added to that company's distribution list. And now I'll hand you over to Calgro M3, and Vickers, please could you share your screen and take us through the presentation? Thanks.
So that everyone gets the message. Welcome everyone, thanks for the opportunity. Thanks for Unlock the Stock, Mark, the finance guys, Deborah, and all the sponsors here today. Let's see if this works. Okay. I believe the core message from Calgro for the year is basically that we stuck to the plan of what we had a few years ago, and we set out to all investors of effectively a well-diversified property portfolio in both our Memorial Parks as well as our development business, and roll out the current pipeline. Nothing funny, no funny investments, no strange strategies, basically just roll out pipeline. And to do that, we've got the adaptable team. We generally do very good market analysis. Yes, we still get it wrong here and there, but we focus on what we're good at. We're good property developers. We close the construction division. And now I've got a pipeline which ensures that we've got long-term sustainability, and sustainability, that hashtag sustainable actions, is an inherent part of what we do to drive the business and building legacies, changing lives, and following the different markets in the businesses we operate in. We've got growth in both our businesses, more than 20%, developments as well as Memorial Parks. And then if you look at our balance sheet, it's at the strongest ever. Yes, maybe only just stronger than at the year end, but take into account that we bought back 18.6% of our equity during the last 6 months. The balance sheet is quite a bit stronger because the equity, the profits we made, was effectively utilized in buying back the stocks. Okay, sorry, admin. We handed over 949 units, and if you look cold at the financials, say, but hang on, you handed over less units than the previous year. The reason for that is we're now primarily focusing on the private sector. It's not a permanent strategy. Yes, we will do government work again in future, here and there. We always said we want to invest a business that have an anchor of private work, one-on-one sales, and all that units was in the private sector, and hence the increase in revenue, even though the units handed over went down. It's basically just a balancing act where the average price is just higher to the end consumer. Revenue growth of 13.5%, already said both businesses grow by more than 20%, gave rise to 78.88 cents earnings a share. Then if you look at the balance sheet, and that was an uptick of 25%. But then if you look at the balance sheet and take into account that we bought back 18.6% of our equity, average price R2.63, just short of 60 million, 59.5 million rand spent on that. You take into account that we've got 3,398 serviced opportunities being serviced. Once we're done with this infrastructure, if you look at a project like Flare-Off, there's more than 5,000 units to go. You'll have 1,500 of them fully serviced, including the parking, everything. But from a bulk and link perspective, your long-term capital, everything will be in, barring one intersection. So the full link water line is in, the ring line is in, the ring electrical line is in, the new outfall sewer that actually serves all of Florida after Zama's damage line is in. So all the bulk and link infrastructure is installed, so the capital is in the system. We still have 2,118 units under construction, of which we said more than half will be handed over in the second 6 months. So we're still predicting some growth from that. Again, all open market at the same pricing points you're currently targeting. And even though we've done all of that, cash increase still 11.2%, showing that we're cash positive. When you look at the cash flow statement, your cash from operations was in line with your profit after tax, actually just in excess. Our net debt to equity is very stable, down from 0.62 to 0.61. It's the strongest it's been in 10.5 years. And our NAV, because of the share buybacks, because of the 25% profit growth, effectively grows 26.1%. to the group to just short of 11, of 12 rand, 11.99. Just quickly, we've got this target of 50% women. We're currently sitting on 46, so making good progress there. We're still level 1 empowerment contributor, ISO registered, United Nations Global Compact advanced signature that says we're not only looking at the financial side, we're looking at everything else as well. And then, of course, as the group's profit grow, we're making a bigger impact in the communities we serve. And that was also our biggest risk mitigator against land invasion, community unrest, because we serve these communities through various activities, sports fields, training, blanket drives during winters, and the like. Just quickly, the underlying businesses, and I'm going to speak, this is more photos just to showcase it. On your left, we've got Jabulani Junction, middle is Flare-Off, and then Southfields on the right. Sorry, that picture shrinked a bit bad. Effectively, the van business grew 13.5%, focusing from fully subsidized to bonded homes, although under the period under review and the next period was only bonded houses, showing that we can operate, we can grow in a challenging economic environment, even though the interest rates are where they are, excluding government work. Where do we see interest rates going? We think we're right at the peak, maybe another 1% increase if you look at yesterday's inflation data, but by the end of the first quarter next year, beginning of second quarter, we start seeing a decrease. You'll have seen that we spend double on marketing expenditure to attract a lot more clients. We these days have to attract 5 times more clients to site than what we used to. And even the clients themselves realize that, hang on, maybe in the current market it's cheaper to rent than to buy. But it's our responsibility to show that you still build wealth and the like. Your bond is very similar to your property rental, but you have to add your total cost of ownership, your levies, your rates and taxes and the like. But January, if the interest rates start coming down towards the end of the first quarter, plus January you have a rental increase, those two starts balancing out again. And if we can just, that's why we're servicing so much units. We're actually forecasting that we'll convert quite a bit more of the current marketing effort at that point and see growth for the next period. We've installed roughly 250 million of infrastructure, another 150 to come to complete these units. And then by mid next year, we'll have more than 5,000 service opportunities of our pipeline of 20,000, excluding the 2,000 under construction. So total pipeline, 22,000, 2,000 under construction, 5,000, just over 5,000 should be fully serviced by mid next year, and 15,000, 10 of that partially serviced with bulk and link in place, and 5 a lot more services to come. Just again showcasing Flare-Off on the wetland and how Calgro has transformed into much more luxurious units. If you look at the blocks at the bottom of the picture versus the back, which is much more basic. Our sales and marketing effort these days, you'll see we can compete if we take that same block and we plot it in the heart of Sandton or in Bryanston, or even in adjacent areas. We should be able to get a lot more for those units. And hence why we target a GP margin of between 20 and 25% sustainably. Can we get more for the units even in our development? Yes, we can. But because we may be underselling it a bit on the price side, that's why the banks are still giving us all 100% end-user finance, and that's a sustainability action. But if we look at the material, we're quite proud of how we're uplifting these communities. If we then go to Memorial Parks, although revenue was flat, you cannot look at the revenue number. That's an IFRS number. You have to look at like insurance company. Our cash is actually up 33.5%. If you look at true sales, it's actually up 52%. And the reason for that is our lay-by sales, which a book we started in the previous year. That book had doubled in the last 6 months. And those sales were only recognized when we get the last installment. The default rate, the fall-off rate over the last 12 months has been roughly just under 4%. So it also gives you that book size of 21 million, start giving you quite a good forecast in terms of cash collections in this business going forward. And we hope to announce another park before the end of the year. Financial review, I'm just going to touch on a few numbers. We already went through the revenue number, the growth in revenue, 13.8%. There's nothing much on the balance sheet to touch. If we get to the debt, yes, we've got 160 million in debt maturity still to come. 77 of that was settled post the year end. 53 million have already been refinanced. So next year, 160, the year after 211, 157. So quite nicely staggered out. So no big pressure on there. The 909 number post the settlement of the 77 post the half year end actually brought our debt down to 840 million. So a decrease in debt. And if the refinancing, our average cost of debt at the year end was 12.76. It's currently sitting at roughly 10 basis points less than that. Look, from a covenant perspective, 0.61 versus our covenant of 1.5. Our internal group targets we set under 0.75. We're well clear of that. And your debt service cover ratio 2.27 versus a cover of 1.2 regulated. Okay, I can't go back. I think this picture is important for me. This child, this girl is standing for what Calgro stands for. We need to uplift South Africa. We can make such a big impact in that child's life. You put a family in better accommodation. The unit looks it's so much more of a lifestyle choice. She gets a better night's sleep. She can study not under candlelight, but under proper light. Better ablution facilities. Her parents get better sleep. Her parents are closer to the office or to the place of work. One parent can spend more time with the family, uplifting the family values. The other parent more efficient at work, uplift themselves. And the child study better at school, do better at school, and create already a better future for her. And because her family's got a better income, because of efficiencies and this lifestyle and uplifting themselves, they can also offer a better future for this child, put them in better schools, better tertiary education, and the like. And this is what we're about. And my next slide on Mandela, it's not, don't judge us by our success, judge us by how many times we've fallen over and how many times we got back up. I think that stands right for South Africa, but also for Calgro. And the benefit is the management team has been through the difficult parts. And it's fresh in our memory, and hopefully we don't go back there. Sometimes we are slow learners, though. We focus on diversification, growth and sustainability. We see lots of growth from Memorial Parks, as a new park to be added. Frankenwald to be added from a growth and sustainability, another 20,000 to 50,000 units. Our products we tailor to the market. If you look at our products now, it's a lifestyle choice. You can literally just block that block in Sandton. Got good market insights. We understand the lower LSM. We've proven that. We're profitable outlook going forward. We're already profitable for 5 periods in a row. Got financial balance sheet stronger than ever. Digital innovation, there's some interesting things to come, and we're trying to improve wherever we can. Share buybacks done, and a dividend policy should be announced in May with our results release of the February 2024. I thank you for your time.
Thanks, Vickers. A very quick whip through and an admirable outlook there for everybody. Leon, it's just your turn now. So if you could please share your screen and take us through the Bell presentation. Thanks.
Thanks. Yeah, I'm Leon Person, the Group CEO of the Bell Equipment Limited Group. I'll take you through an overview of our group, briefly discuss our operations, our financial results for the 6-month period ended 30 June 2023, and then we'll also touch on the way forward from here. Right, we have 2 distinct businesses, one being a global and niche product OEM, and the other being a dealership business in Southern Africa. We structured our OEM business into 3 distinct divisions, being a focus on mining and construction equipment, earth-moving equipment, underground mining equipment, and forestry and agricultural equipment solutions. And this is as a result of our strategic thrust to enhance our product offering and IP development, and is obviously in addition to our global growth objectives. This focus ensures that we dedicate resources to the development and introduction of world-class products, its distribution, and most importantly, the support thereof going forward. In South Africa, we own our dealership network, and it distributes and supports our Bell OEM products, and these are complemented with the sole distribution right of other world-leading products from OEMs such as JCB, Calgro, and Finlay. And then finally, and yet critically, all our products, our operations, our dealers, and our customers are supported by aftermarket and technical support operations globally. We have manufacturing facilities in Richards Bay, South Africa, and in Kindl, Eisenach, Germany, together with our dealership network in South Africa, Zambia, and Zimbabwe. And furthermore, we have support operations in Germany, France, the UK, the USA, and in Australia. Unfortunately, our support operation in Russia has been mothballed for the time being. All our operations are complemented by our aftermarket parts distribution and logistic hubs, which is in Charleston in the USA, in Alsfeld in Germany, and in Johannesburg, South Africa. The footprint at both our manufacturing facilities, as well as our logistic hub in the USA, have been increased to accommodate our growth. Overall, the previous half year has been very pleasing for the group, with solid results posted in the face of various challenges. These included continued supply chain constraints, labor shortages at our German plant, huge exchange rate volatility, high inflation and interest rates globally, and structural challenges and deficiencies at Transnet and Eskom locally. However, globally demand was strong, and our investment in market growth, support structures, and locally our product distribution partners JCB, Calgro, and Finlay all contributed to us capitalizing on the opportunity for good revenue and profit growth. I'm also using this opportunity to show you a picture of our new Bell designed and developed motor grader, the most significant IP investment we have undertaken in recent times. This particular unit is one of more than a dozen test units that are deployed in various applications as part of our product testing and validation process. Our extended range of motor graders will go into production towards the latter part of next year, and over the next few years, it will be joined by more new products to be launched for global distribution. External dealer sales from our South African OEM represents just under 20% of group sales, where strong global demand and good production volume growth facilitated a healthy increase in profitability of this operation. The increase in inventory and interest-bearing liability is mainly due to planned increase in production volumes to meet the higher global customer demand, as well as certain component shortages from suppliers and shipping delays from South Africa, which resulted in the higher levels of components, work in progress, and finished machine inventory at half-year end. We will continue to invest in new product IP and digitization, and as the global markets remain strong, together with our healthy order books, we continue to invest in working capital to pursue the available growth opportunity. Also, leveraging our good empowerment credentials, we'll be pursuing manufacturing opportunities aligned with our core competencies with the imminent launch of Bell Heavy Industries. External sales from our European OEM operations represent over 40% of group sales now, growing from the 35% it represented in the prior year. That's obviously mainly as a result of the strong Northern Hemisphere demand. Profitability was, however, under pressure because of prior year committed orders, whilst we experienced unprecedented inflation and cost increases of input costs and costs associated with the short-term interventions to overcome the supply chain challenges and the labor shortages at our German factory. The Northern Hemisphere market, however, remains strong, with the USA market still representing the biggest opportunity for the year ahead, whilst we are seeing some leveling off of the European and UK markets. Although we have seen quite a healthy sales growth at our dealership in South Africa, it now represents just under 35% of group sales, compared to the 40% in the prior year. Operating profit increased on the back of higher demand for larger products used in mining, a good aftermarket growth, as well as from the contribution of the distributed JCB, Kibelco and Finlay products. We are cautiously optimistic that the momentum from commodities will continue, but are seeing very little business from construction, infrastructure and road building. We are growing our footprint for agricultural products by appointing independent dealers, and we've established an underground mining equipment division to focus on growth opportunities in this segment of the market. And soon we'll be introducing new owned developed products to complement our existing range of underground mining and forestry products. In terms of our dealerships in Africa, which really only represents Zambia and Zimbabwe, very small, representing 6.5% of our business. We were able to capitalize on strong commodity-led demand, and we remain committed to our customers in these territories and will continue to focus on enhancing the aftermarket support in their markets. I'll now take you through a quick overview of our financial results for the 6-month period ended 30 June 2023. Our revenue increased nicely by 42% if compared to the previous interim period, and our operating profit for the period increased by a healthy 74% to 536 million for the 6 months ended 30 June 2023. As a result, our earnings per share and headline earnings per share grew by 64.1% and 63.3% respectively. I did mention during the operational update that we continued to invest in inventory to pursue the global growth opportunities. And although our number of inventory days at 220 is similar to the 31 December 2023 number, there are huge increases in work in progress as a result of the component shortages that either caused units not to be signed off or buffer inventory to assist with continued production. And then similarly, you would seen a huge increase in finished manufactured goods, and that's primarily as a result of shipping delays from South Africa. As a direct result, our net debt and interest paid increased, but I'm pleased to say our gearing, our interest cover and net debt to EBITDA remains at optimal levels. Looking ahead, our outlook is cautiously optimistic, and this is driven by robust order books extending well into the 2024 year across most markets. We maintain a strong growth focus in the USA, the world's largest ADT market. However, in South Africa, whilst the mining sector remains resilient, the construction industry continues to face challenges due to low infrastructure spending in a weakened economy. Investment in innovation, new product development and digitization remains a key priority, and this includes the piloting of autonomous ready ADTs in many global markets. Our expansion plans in the Northern Hemisphere aims to bring us closer to the global markets, and we are confident that together with the successful execution of our growth strategies, we will enhance our resilience and relevance objectives, in addition to meeting and exceeding the financial return expectations of our share owners going forward. That's it from my side. Thank you very much.
Thanks very much indeed, Leon. That was a very good overview of the business. To our attendees, please now, it's the turn to select your room that you wish to join by clicking on the panel at the bottom of your screen. Hopefully that's still applicable. And here's to the juiciest part of the session, we believe, is the Q&A. So please select which room you want to go in, and I will leave you to the finance ghost and Mark Tobin.
Okay, I think let's start so we don't lose any time. So to those who have chosen to join this breakout room, welcome. I'm obviously the finance ghost, as you've noticed. This is the Calgro M3 room. If you joined the wrong one, now is your chance to go to the other one. But don't do that, hopefully, because we're keen to have you here. And to the team at Calgro, thanks for doing another Unlock the Stock with us. I think you guys have been very committed to the platform since we launched it, really, and just to getting that story out there to retail and institutional investors alike. So thank you for that. And I think before anything else, just congratulations on the performance this year. It must feel pretty good. I just checked now, share price up 43% year to date. So given, Calgro has been through a tough time in its history, and I think it's something you guys openly acknowledge. It must be feeling, you must be feeling quite good, I would think, right?
Maybe relieved.
Yeah, good / relieved / any of the above. And I think particularly impressive having achieved this against the context of such a difficult economic backdrop, so something I maybe just want to start with there is in terms of the affordability, for the properties among your customers and everything else. Obviously South Africans under a lot of pressure, interest rates are higher. I mean, I think we've talked about it a little bit on previous editions of Unlock the Stock, but it's always worth revisiting. Is just your customers who are buying these properties. How are they typically funding these things? What help do they get? How defensive is the model actually, particularly given that, for want of a better description, middle class and upper middle class property, I think, is under a lot of pressure, and I think is going to get worse. Seen some headlines this week about buy-to-let investors wanting to sell, and how tough that's going to be for them. So I think maybe just a bit of understanding around your part of the market and why that is more defendable.
Okay, so I think the first thing to say is that property or proper home in our market is not a luxury, it's a necessity. If you look at the market we serve, between 500,000 and 600,000 rand, that's effectively joint household income of somewhere between 15,000 and 20,000 rand. So those clients really have nowhere else to go. So I think that's the first very important thing to note on that. Then how defensive they are, we need to get about, as I said earlier, 5 times as much clients to the front door to do the same sales. The positive for South Africa, I think, is that for the first time, the clients turn around and say, but hang on, maybe I cannot afford it. We don't have to go through the whole banking process to determine that. The benefit is we're building up quite a nice pipeline. We know where the person's client is currently staying, what they're paying rent, what their income is. And as soon as the interest rates start decreasing towards the end of first quarter next year, we can go back to that client base and we can capitalize on that client base. So I think that's an important bit. But are our client base under pressure? Most definitely. There's a big demand for the product, but they can't all afford the product. But because of all our marketing and sales efforts, we're attracting a lot more people, so our sales are still good. I think that's basically the question to answer. The answer to the question.
Thank you. Yeah, that makes sense. I mean, at some point in time, everything breaks, right? I mean, it's, fuel inflation, food inflation, interest rates. So yeah, interesting to see the view on, rates dropping next year. It sounds like that's the house view on that side. Hopefully correct. I think it'll do all of us a bit of a favor, unless you're a bank. Anyway, moving on perhaps from there, one of the other issues in South Africa, of course, is always municipal service delivery. And obviously Gauteng always top of mind on this topic. So I think, if I was sitting down and making a list of sort of risks to Calgro, that would have to be up there. So I think it's worth addressing. To what extent do you see municipal service delivery I suppose not just Gauteng, but I think specifically Gauteng, let's be honest, as a little bit of a risk to the business, to ongoing developments, timing, etc.?
Yeah, so I think service delivery across the country is difficult. Gauteng is maybe just have maybe just shown the cracks earlier than other provinces, but a lot of the other provinces are showing the same cracks, just on a slower basis. It will get there because there's no money to fix it. I actually see Raymond is on the breakout room, so we've got a contractor of a lot of experience in this. But infrastructure, if you don't maintain it over time, the reality is that you can't maintain it, you have to redo it. So what Calgro is doing is, whenever we go into a property, even redevelopments, we literally take everything out and we redo it. Do we see acceptance from the local councils to allow us to do this infrastructure? Yes. Do we get back as much as we should have gotten back in an ideal cycle, in an ideal environment? No. But the business model has shifted where we say we don't want to be reliant on government, and therefore we're doing our own infrastructure, and we almost masters of our own destiny, if I can call it that in inverted commas. So it is an issue. It will continue to be an issue. There is no funding in our perspective to fix it soon. I think because of the lack of maintenance, there's going to cost government a lot more money than they think over the long run, but they currently aren't the money to do it. So it's a chicken-egg situation. It is what it is, but it's not holding up Calgro development as such.
Thank you. That makes a lot of sense. So question in my DMs, and I suppose linked to, how tough it is out there. So I think it's a very, very good question. And that is around your marketing expense. So obviously the harder it is, the more aggressively you need to market. And just a question around, well, firstly, how much it is, to the extent you can disclose that, how much it's growing. And I suppose more high level is, do you expect it to increase indefinitely or for as long as interest rates remain high? And then just the last part of that question is, is it disclosed separately on the financials and on which line? So I guess just marketing expenses overall, how much can you disclose and talk about? And then what do you think the trend looks like long term as consumers are under pressure?
Okay. I'm sensitive to parts of the question because the way we attract our marketing is a bit of, let's call it our IP, but I'll answer it in parts. So the specific, let's call it the hard printing marketing costs, is separately disclosed in the administrative cost note, and that's partly why administrative costs jump so much. What we've disclosed separately in our commentary, but that's not all sitting in marketing, it's some sitting in the GP line, and I'll touch on that now because otherwise the answer might not make sense. We believe that our marketing cost currently is up about 2% of, let's call it revenue. So extra 2% cost to that. So that number is quite substantial. Will it be a consistent? Now, sometimes bad times are needed to realize that you were doing it wrong all along. So maybe if we market it a lot more and better and more analytics and more data driven in the good times, we would have actually done a lot more revenue back then. But as I said, sometimes you need bad times to learn a few lessons that you're actually not as efficient as you think you are, or as good as you think you are. So I believe that we've learned lessons. Will it stay as high as currently? Most probably not. Will it go down to the previous levels? I don't think so. I think we'll have a lot more focus on there. I think we'll continue with a lot more data-driven analytical marketing, especially on the social media space, but also on just your normal print, where you distribute, how you distribute, where does your clients come from, what's your typical LSMs you target and the like. So that just makes it the cost will always be high, and I think we can generate a proper return from it. So that's why it will be high, not just because we need to attract the sales. Then on the GP side, the GP stayed consistent, but I said that extra cost is in the future. Remember the gross profit margin, because of how we really looked at last few years, our densities, how much construction square meters we build for saleable square meters. The reason our GP is more consistent is because we actually build less construction area, or actual construction area for saleable squares, because of our efficiencies and designs we've done, as well as our densities went up from, let's call it 170 units a hectare to 100, close to 200 units a hectare, just with much more fancier designs and also smaller footprints because you built less construction meters. So you didn't lose a lifestyle choice. In fact, the lifestyle choice was enhanced by all of this. So yeah, it will most probably, to answer in simplicity, it will stay higher, maybe not as high as now, and the cost is up roughly 2% of cost.
Maybe just to add, from a Memorial Parks perspective, we generally spend about 75 to 80% of our annual budget as well in the first 6 months of the year. And the reason why you do that is that period, sort of May to August, that is, from a cyclical perspective, that's winter months, and that generally is when you see an uptick in burial rates. So I think we've been a lot more aggressive this year in sort of sticking to that numbers, whereas if you compare that to your previous period, we still had quite a bit of marketing challenges in there. We're in the process of restructuring that department altogether. So when you're looking at comparatives, our marketing expenses is up quite substantially. Then obviously running down into Feb, that comes back down. But like Vika said, it's a lot larger, but it's not a train smash in the bigger scheme of things.
Got it. Thank you. That's really useful. I think let's stick with gross profit while we're at it, because obviously marketing is one part of it. There are a lot of different things that go into it, of course. And I think maybe the one thing that sticks out to me is you've got this kind of target range of 20 to 25%, which is quite broad. And then your year-on-year performance was insanely consistent. I think it was 10 basis points different, if I'm not wrong. So I guess just to help investors understand, what is the thinking behind that broad range? Like, what are some of the big variables that maybe keep you up at night? Because there must be a reason why the range is quite broad, as well, as much as you've managed to, keep it so consistent year on year, which is very, very impressive. The range is still there. So why is that?
Depends what you do. So the range has been fairly consistent because we've been doing fairly much the same thing, and doing the same thing, I mean targeting the same market, so the open market and the like. Once you start doing fully subsidized housing, you don't make these margins out of fully subsidized housing. Why do you do fully subsidized housing? Then it's a question, because on the back end of that, you get some infrastructure funding, which decreases your balance sheet risk because you have a lot of your bulk and link infrastructure funded by government. So therefore, you're prepared to take a lower margin on the RDPs, but over time, that actually enhances your margin or your risk perspective on the open market stock. Further, why the range is so broad, remember, markets go through cycles, and we don't want to say, listen, we're now consistent at 22%, and then every time we drop below that, we need to give this big explanation. It's cyclical. So it's product driven, it's cyclical. It depends on typically now the marketing expense, and so because of the efficiency drivers, we're still able to keep it there. But it will always be fluctuating. It also, if you look at your freestanding houses or a 3-bedroom versus a 2-bedroom, so the bulk of our stock currently is 2 bedrooms, but the construction area goes larger, it's still only have 1 kitchen. So your margin generally on a 3-bedroom with still the same kitchen, 1 bathroom is better than on a 2-bedroom. But the 2-bedroom is just that finite pricing point we currently have. So it's difficult to go as specific as we ain't. And I think the fact that it's only 10 basis points difference is, I don't want to say it's coincidental, but it is somewhat coincidental.
Yeah, so typically what you'd find is we generally don't do projects if it's, we'll only take on a project if it's typically this 20 to 25% range or more than that. But within the project, there is just so many components with such a wide range of margins, like Vika said. And it very much depends what you're doing at what specific stage and what the relation of those are to each other, which can sometimes push you even lower than the 20%, and sometimes it can even push you higher than the 25% to give you this blended margin of 20 to 25%.
Got it. Thank you very much. So lots of mix effect in there, and I think that definitely helps with the understanding here. I think let's talk a little bit about the memorial parks. It always comes up, and I think on previous Unlock the Stocks, there's been commentary around how the parks are pretty much seen as a way to help cover the group OPEX expenses as well. It's not exactly the way you think about it, but it's one of the ways you think about it in the group context. Is that still the case? And does the lay-by model actually change anything here? And then I guess linked to that question is, how big can the memorial parks get? I think you made a comment in the formal presentation that you're considering another park, if I heard correctly. So just a bit of understanding around the memorial park side of the business, how big can it get, etc.
Yeah, can I start with the admin expense and I'll hand over to Valdi? Currently, it's 70% effectively of administrative expense. So that's definitely still the way we think about it. And as soon as it will cover 100% of that, we'll try and go after the interest. So Valdi's pushing us to repay the debt so that his precious a bit less. But yeah, the plan is that all your fixed costs get run from a memorial parks, which is way more consistent. And the laybys will actually enhance that, and Valdi will touch on it now. And that your the development business will always be lumpy in terms of cash flow. That's got a lot less month-to-month pressure.
Yeah, so I think if you look at your typical market for memorial parks, your sales generally come from, let's call it two areas. One is when there's a death in the family, and the second is on a reservation basis. Now, your main challenge when there's a burial is not money so much. Because most people, when they pass away, they've either got a funeral policy or they've got a life insurance policy, or family just on a broad basis contribute to the funeral. So money is not really your challenge at that point. The challenge there is, does the market know about you? Do they know about the product offering? It's a broad-based market awareness problem. So that's the one end that we're targeting. The second leg to this is the reservation side of things. And that's where the laybys come in. So if you're coming to reserve, you're not waiting for death where money is really no object, essentially. This is a situation where somebody needs to come and swipe their credit card or do an EFT for 30,000 Rand for a grave, and their affordability really becomes a challenge. So sort of last year, July, we said, listen, we need to start introducing a product that makes it more affordable for our consumers to actually buy these graves. Yes, we'll target the marketing, and that's a separate thing where we want the awareness, so that then burials are taken care of. However, if we can introduce a product into the market where we allow people to pay it off over a longer period of time, you enhance affordability, and then you can secure your reservations. And that's really where we introduced this lay-by offering, where we allow customers all the way up to 24 months to pay off their graves. So the way I view it is that it actually fast-tracks your cash flow as opposed to hindering it. There's a very, very small component of people that would have actually come and bought a reservation and paid for that 30,000, which now opts for the lay-by. And yes, you do get one or two of them, just because it's interest-free, it's easy. So essentially what that unlocks is it allows you to lock in your sales, to have visibility of what those cash flows will be on a monthly basis for your overhead. So it really enhances that almost annuity flavor of the business even more. Obviously gives you this visibility, and then you know the customer's locked in. So at any point in time, if somebody passes away and they need to use that grave, you top it up, and you still get your full purchase price at the time. So really, it's more of an enhancement than what it does detriment to the business, with the overall view then still that those consistent cash flows that you get from the business, that needs to be sufficient to grow, to cover your group overheads in full, and then later on the interest bill of the group. And that really makes the group essentially extremely sustainable, because you could, in a very unlikely scenario, you can shut down all of the sites and you'll still be 100% fine. So maybe in terms of size, that's sort of where we're going in terms of size. And one of the things that we're going to have to do throughout this process in order to get to that size is add more parks. So it's always been a consideration to start creating a national footprint. So we are looking at other provinces. We're looking at expansion within one or two other provinces that we're currently operating in, just to have a little bit of a broader base. But you should hopefully see that announcement soon, that we've acquired another one. And then it's just rolling that out and getting that up to speed.
Thank you. Very, very interesting. I think you've touched on the interest cost, and that leads me nicely into the balance sheet, which I think is where we need to go next. So obviously the share buybacks have been a huge theme for you, definitely a driver of the share price performance, and in my opinion, without doubt, the right thing to be doing. If I kind of have a look at your balance sheet and your cash flow statement, it looks a little bit like you're almost willing to leverage the balance sheet a little bit in order to keep driving the repurchases, like a little bit of a net raise in borrowings, and then, more than that invested in stock repurchases. You're well below your debt covenants, so you've got headroom there. I think that's clear from your reporting. So I guess what I want to touch on is, point one is, are you happy to keep running at these sort of leverage levels and potentially even adding a bit more for the sake of share buybacks? So juicing up the balance sheet a little bit. And then how do you think about the buybacks? Is it a case of, well, as long as you're at a discount to NAV, you're going to go with buybacks rather than dividends? Or, just how do you think about that buyback policy and also going forward as well?
Yeah. I'm not sure we leverage the balance sheet, because cash is also up. So the differential between cash up and debt up is very close and similarly aligned. And we actually decreased the debt after the year end, or after the half year. So I'm not sure the statement is 100% correct, but it's a principal discussion. So I think, will we be prepared to leverage the balance sheet a bit at the current debt levels if we know the money is coming to buy back shares? The answer is most probably yes. Share buybacks in our case is not a separate discussion. It's a discussion that forms part of a capital allocation discussion that we set out to say, we first look at operations. So we need to stay in operation, we need to grow operations. So immediate houses under construction, and that 118 units under construction is expensive, because open market units, we pay for them and we get paid right at the end when we hand over. Okay, maybe borrowing about 100 open market freestanding houses we built with the client's money. Then we installed the infrastructure, so that is your medium-term growth. Then we're looking at new memorial parks, which is your longer term growth and that sustainability flavor. Then we look at share buybacks. We look at dividends, and dividends and share buybacks also not mutually exclusive, but I do believe that the one rank ahead of the other in terms of value creation, because with a dividend, you give everyone money. For share buyback, you take out your short-term shareholders that don't want to be here. And then when you start paying dividends, you spread it amongst the guys who wants to be here long-term. And because you divide by such a lesser amount of shareholders, it's actually of greater value. And then alongside that, potential acquisitions and growth comes. So we consistently evaluate all of those in terms of risk profile, returns, where are we in economic environment, where are we towards next year's election. The biggest risk, and you touched earlier on infrastructure, the biggest risk for Calgro is that in the build-up to the election, there's such a lot of instability, and even post-election, depending on coalition governments, that the administrators are not prepared to make decisions, and therefore you can't do basics like rates clearances, plan approvals, and that delays our transfers, which creates a cash flow gap. So we need to plan for that as well. So for us, it's all part of that process, but where our current debt levels is and where the balance sheet strength is, we believe there is some room for gearing, potentially for additional share buybacks. But we're considering everything, all of those, every time we discuss share buybacks.
Fantastic. Thank you. Yeah, I think for me, I got those numbers from a bit of a narrow look at that section of the cash flow statement, but you're right. In the broader group context, it's not like you're ramping up debt specifically for buybacks. I guess for me, it's just interesting to see you're not losing sleep over the amount of debt on the balance sheet and then pulling back on buybacks as a result. I think that's maybe the point I was trying to make. You know, the buybacks are there, they're part of the game. And I think you guys are doing the right thing, as I say. You know, maybe we can just address that sort of discount to net asset value per share. Classic, not just the JSE issue, it's a worldwide issue. Many companies deal with this, and there's a million theories about why it's there. I had a little bit of a look at return on equity for you guys and maybe the risk factors in there. Obviously, you're doing everything possible to drive earnings, but I guess the question was, are there any lazier assets on the balance sheet that you think might be able to come down to kind of juice up return on equity, close that gap to net asset value per share? Or would you say that the asset base in the business is correct at the moment? It's not like there's a lazy portion of the balance sheet, and it's difficult to answer as a property company, obviously, but you know, any commentary at all around what can you do to get ROE higher? Is there anything you can do on the balance sheet?
Shucks, Maurice. Okay, I'll try and answer that. I don't think that selling of lazier, in other words, non-productive assets is a sustainable way of driving return on equity, because once you sell it, you take the profit, you take the cash, and then it's done. So I think that principally might be flawed without thinking too much about it. Is it underperforming assets? Yes. Are we looking at potentially offloading of some of them? Yes. And KwaNobuhle, which we generally disclose as up for sale. Same with the last piece of KwaZulu-Natal land and Mhlanga. Yes. But there's one or two other pieces as well. And then I think what will drive the return on equity is what we utilize that cash for. So it might be that is the amount of cash used for more share buybacks, take out more of the short-term shareholders, reduce the equity, so immediately you're driving the profit on the back end is on a lower equity amount, so that enhances return on equity. It also might mean that we even look at more driving revenue to drive even greater profits, because your equity balance is there and you need to generate return on it. The risk of all of that always is that sometimes you grow so quickly that, and we've made that error, that return on equity is phenomenal for a few years, but you don't properly consider the additional risk that adds to the business. With additional revenue comes additional staff, additional labor actions, additional layers of management, where every time you add a layer of management, you lose efficiencies. And I think that's been proven in Calgro, and no one convinced me differently. But you lose that, and you're doing all this much revenue, and you actually don't make more profit at the end of the day. So I think, to answer you in short, there is lazier assets. We know about them. We are considering them. The biggest challenge is in this market, to sell anything in the current South African context, no one wants to write proper checks because why? No one else is going to. So let's sit back and see. And we look at it as well, the opportunities we have. We say, but listen, these opportunities might still be here this time next year. So why do we have to take additional risk now? So we are looking at it, but there's a few challenges as well.
I think the last thing I want to touch on, and by the way, I mean, obviously as rates come down, the market's required rate of return would technically come down, and that actually helps you in terms of closing the discount to NAV. So I think what's been so impressive in the share price performance this year is it's been in a higher interest rate environment, right? I mean, if I'd said to you a few years ago, hey, you're going to have that kind of share price performance in a year where rates have gone up, I'm not sure you would have believed it possible. So I think Calgro's business is quite nicely geared towards doing well when rates come down, not just the underlying business, but also potentially the share price. I suppose time will tell. And that leads me into, unless something pops into my DMs suddenly, I think the last question, which is just around the cost of borrowing. I think you said you're currently at 12.76, was the note I made during the presentation. Obviously, as you're refinancing debt, are you like, what sort of rates are you refinancing at? So if rates do stay higher for longer, where does your cost of borrowing potentially go? And does that worry you, I suppose?
Okay, I'll hand the detailed question to Valde, but I suppose I can answer it. We're currently raising 3-year unsecured at 390, JIBAR plus 390. And remember, all our debt is unsecured. We've got no bank debt. There's no security on anywhere in our balance sheet. So effectively, because all debt is unsecured, everyone is secured. But what it does do is, if there were to be challenges, shareholders and debt providers have to get around the table and all sit and work it out. So the equity provider is actually a lot better protected, if I can call it that. And we're raising 5 years at 425. So that's roughly where we're refinancing. The debt levels don't keep us awake at night. The interest bill don't keep us awake. Yes, it's never nice. And I think if the interest rates come down, it will. If interest rates on 800 million comes down with 1%, that is 8 million a year, and after tax, 6 roughly, 8.5 a year and 6 after tax. So it immediately adds on our current profit on an annual basis at 3-4%. But again, we need to focus the things we can control, not the things we can't control. So the interest cost is what it is at this stage. We always try and drive our cost of borrowings down, but it doesn't keep us awake at night. But I think if you look at the rates, the balance sheet strength is definitely impacting and improving the cost of borrowing.
Maybe I can just add 1 or 2 items on that. Is if you look at that maturity analysis that was put up, all of the debt that matures in the 2024 financial year, so all the way up to Feb next year, all of that's been refinanced to date. So I think the last one will come through this coming week, Monday. You'll probably see the cents today or tomorrow on the refi on that one. And on all the refis, we've actually managed to secure cheaper debt than what we have in the past. I think the one thing which we'll probably capitalize on this time around, which we didn't do previously, is generally when things go well, everybody wants to give you money. And then when things go not so well, then nobody wants to give you money, even though that's the only thing that'll solve the problem. So we might temporarily take up some additional facilities and rather just either park the cash on balance sheet and rather have that negative carry for a sustainability perspective, and or have a facility and pay those commitment fees and just sit on it. So the intention is definitely not to increase a net debt to equity. But I think raising, let's call it gross facilities, I think is definitely something that's for consideration at this moment.
Yeah, that's very, very interesting. I see the breakout room is going to close in a minute and a half. Last thing I just want to touch on, so I had to quickly Google and make sure on what the current JIBAR rate is, but it sounds like that current rate you're raising at is almost slightly below your average cost of borrowing. So does that mean credit spreads have come down for you guys? The banks are looking at you more favorably. Let's end on that note.
Correct.
Yeah, yes. Three nods. Okay. Well, that's happy news for investors and for you. So I think well done. Again, I mean, let me leave it there. I think thanks to everyone for attending. We'll go back to the main room now and to the Calgro team. Yeah, congratulations. Obviously, I follow almost every company on the JSE, really. There's not a lot who have managed to have a good year in the share price performance. And yes, it is easy to draw a long-term chart and get upset, but at the end of the day, you can't change what happened all those years ago. You can only do the right stuff now and learn from it. And yeah, I think well done. It's been a really, really strong share price performance and good reasons to believe that it may continue, barring any major macroeconomic stuff. So hopefully South Africa keeps it together and you guys can keep doing what you are doing. So yeah, I think we'll leave it there. Thanks to all the attendees. You can leave the breakout room and go back to the main room just for the closing comments. And it's been another great Unlock the Stock. So thank you, Calgro, for your support.
Thank you very much.
Thank you, guys.
Thank you.
Leon, thank you very much. I'll just reiterate what Deb said at the start there. Thanks very much for coming back and giving us an update on all things Bell. I'm just going to give it another couple of seconds here to let people, I see they're still filtering into the breakout room, and I might just kick off with the first question. Can we maybe just touch on the third party distribution? That's looks like it's working very well. Is there potential scope to add in more brands into that mix going forward? Because as any kind of distribution business, once you've got the capability and the kind of infrastructure and everything in place, pushing more volume through it really can accentuate margins. Or the couple of brands that you are doing with that model, is that the sweet spot, do you think, or do you think there is a potential for another brand to plug in there?
Sure, Mark. Yeah, I'd like to say for the time being we're at an absolute sweet spot. I think just introducing brands to leverage the infrastructure that you've got and to enjoy the benefits of economy of scale, that would be wrong. I'm listening to our customers is the most important at this stage. Our customers have a certain desire for products, and then most importantly, the support thereof, not just the technical support, but also the aftermarket support. So ensuring that you have a successful customer with a suite of products that allows him to make a success is definitely the objective that we're pursuing right now. Having said that, that does not mean if we see good opportunities going forward for additional product distribution that we will not assess that properly. But for right now, I think we're at quite a good spot. We're representing world-class brands, JCB, Kobelco, Finley. We're really fortunate in terms of the excellent product lineup that we've got.
Yeah, and maybe just a follow-on question from that. In terms of those deals and the kind of renewal cycle, are any of them up for a renewal in the next 12 or 24 months?
No, Mark. Ordinarily in our industry, the capital equipment industry, you'd like to have these as extremely long-term relationships, because that's how you build the confidence in the product. And with us performing so well, I don't see that as a risk. But no, none of them are up for review in the short term.
Perfect. And then I just want to talk about the USA story, the kind of global expansion story, more broadly. I don't want to touch wood, say something's got to be flawless in the past, but it has been impressive, Bell's ability to break into extremely competitive markets like the US, and just moving internationally more broadly. We've seen a lot of South African companies try to do it and really get their fingers burnt trying to launch, and sometimes even failing to start. It's not something that's really worked. But how have you guys been able to navigate that? Is it the kind of deep industry knowledge that you've built here in South Africa that you can then deal with those customers? You've known them on this side, and you're kind of going where they operate more globally. As mining is a highly globalized business. Is that the kind of secret sauce to why it's kind of worked for Bell?
Mark, now I actually need to tell you that it's been extremely difficult. If anyone thinks it's easy to just jump over borders and try and capture the global markets, it is extremely difficult. You need to have a mix of things. We do talk about it quite a lot internal. You have to have a world-beating product. People don't change just for the sake of it, and especially not with capital equipment. So you have to offer better than what the established competitors are offering. So that's the first tick that we usually get, because we've got excellent people designing world-class products. I mean, we really we can really be proud as South Africans for what we've achieved in terms of the product lineup that we have developed and that we're continuing to develop. I mean, I have spoken about the grader as well. And then secondly, and this is quite critical, you can have the best product, but if you don't have the strongest and most reliable support of the product, you will be on the back foot. So you know, some of the secret is make sure you invest in the support, the technical support, the aftermarket support, because whether you've sold one product or whether you've sold 1,000 products in the market, they require the same support. So you have to do that investment. And you know, if you look back at Bell over the years, and specifically over the last good number of years, we were always challenged for the amount of inventory we invest in, and many of that had been aftermarket inventory, support structures, and it is really the seed that you plant for the future revenue, the future fruit that you want from those markets. And then the last thing is your people. I mean, we invest in our people. We make sure we have the best people, and we partner with people in country, and really it's a promise that we make to customers. And if you don't have too many chances. In our industry, people are extremely unforgiving, and they've got long memories, and they will tell you when you had let them down somewhere in the past. So we have to work at that every single day. This is not it's not a quick thing that you implement and then you walk away and you walk towards the new market. You got to every single day work very hard at maintaining the trust and the commitment from your customers. So yeah, I'd like to use this opportunity to thank my people for making this possible in all the different facets, whether it's product design or support or customer support, etc.
Yeah, like all, I think successful people, it's something it looks easy from the outside, but when you go into it, you realize how difficult it is. I just want to touch on margins a bit. I know we didn't have long to go through the presentation because we've got two companies today, but they are down a bit at the group level. I just wanted to delve into that. Is that down to mix between the direct sales and the distribution business, currency, or just kind of some one-off costs that came up in this period that are not going to be repeated, and should we expect kind of margins to kind of bounce back in the next period?
Mark, it's almost one of those multiple questions. I'll tick the box if all of the above. There's definitely a mix in there, as you say. When you deal more through the distribution business, the dealership business, you obviously get higher margins. But we've seen some significant once-off costs. We've seen unprecedented cost increases, and with the lead times and having taken orders, you're bound to some of those prices. You can't just overnight change the pricing. We've had massive foreign exchange swings in the first 6 months, and so if you deep dive into the numbers, you'll see some horrific numbers. I mean, the last 6 months I've seen about a 90 million adjustment to that margin, and it comes through at the margin line. So yeah, big once-offs. I would be comfortable and confident that we will see a return to the previous averages, and the once-offs will be hopefully behind us with some stability going forward.
Okay. And can we throw in costs, employee costs? You called it out in the presentation, in Germany, hard to get people. So is that driving kind of wage inflation, just to try and get skilled people into the business?
It's driving two things, Mark. I mean, it's obviously driving more automation. Obviously, there is an element of labor cost, but you know, as a global OEM, we need to continuously assess our footprint and where we do things and what do we outsource, what do we insource. So I don't see that as a massive risk going forward. I do see us as having a number of levers and things under our control which we could pull and implement to mitigate that risk.
Okay. One of the newer lines or businesses I want to talk about was the forestry business. It does kind of fly under the radar a small bit because you're kind of so well known for, let's say, the yellow kit. I'm not sure if the forestry kit comes in a green color, but if we take a 5-year view on the forestry business, what in your mind, what does that look like, or what does success look like in the forestry division? I appreciate it's probably never going to be as big as the traditional business, but if you're thinking about how would shareholders look at success of the expansion into forestry if we fast forward to 2028?
Sure, Mark. I think you're right in assessing that it will never be as big as the construction and mining equipment portion of our business, but it is where we got started. It's our founding products were in the agri and forestry, and we're actually busy with quite a number of exciting new products, and that we're about to, over the next 18 months, launch in that segment of the market. From a capital allocation perspective, that is obviously a question we grappled with to say, do we bet more on mining and construction? And with the IP that we've got and with what we've got planned, we do see that as playing a smaller but yet a big role in our business going forward. We've got legacy customers. We've got huge opportunities for the size of trees and farming operations that we play in, and we do see there's a gap globally for a first level of mechanization there. So yeah, we're quite excited about opportunities that will hold for us.
And in the forestry business, just to say for a second, in terms of incumbent competitors, as you say, if we go back to one of your earlier answers, the first thing you got to do is offer customers a product that's better than kind of what they're already using. And I presume the forestry industry is no different. So if people are thinking of who are you trying to dislodge, or who are the main players in that industry?
Mark, I mean, it's not just a case of trying to dislodge people. I think the benefit for Bell is we are at the coal face dealing with our customers. We're not just an OEM that sells to a whole lot of dealers globally. We do engage with our customers. So if you look and you dive into our product range, you would see that there was quite an expansion over the last 4 years in that field, sort of renewing the whole product range. So I would add that with the products that we're going to bring to market, together with those customer relationships and the ability to service those and support those and ensure that our customers are successful, we're definitely better positioned than some of the global OEs that sit quite far up north, and that may not be at the coal face in terms of dealing with customers. So hence why we see the opportunity.
Okay. And yeah, and you mentioned new products, and you had the slide on the road grader. I just want to talk about R&D for a minute, just the expense and capital allocation that goes to that. Are we in a heavy R&D section of the business now, where these products, whether it's the forestry, the road grader, that's all going to come on stream if we look out 12, 18, 20, 24 months? Or is the R&D budget allocation kind of just going to remain similar? Because there's always going to be R&D in a business like yours when you're in the OEM thing. So
no, sure.
Sorry, I'm just trying to get a sense for the financials. Are we at kind of peak R&D spend and it should come back a bit, or is this kind of middle of the road, and we are the products that are coming on stream is just part of the overall cycle?
Mark, if we don't continue to invest in IP and new product development, we will be going backwards. We have been investing quite heavily over the last 5 years, and I think we've taken lots of criticism from a capital allocation perspective by a number of short-term investors that want the annual returns as opposed to making sure that the group is sustainable and relevant going into the future. So most of the products that we've invested in that we are in the process of either validating or doing the final testing of, about to launch, like the motor grader or some of the processing aids for forestry. The benefit of that significant investment will flow into the company over the next 5 years. This is almost like a forestry business. You plant the trees and you can only harvest it a good number of years from now. And then moreover, selling the product is the first element, but then capturing the aftermarket business a good number of years into having introduced a new product or selling it into the market. That's then when the real return for OEs happen. I think, seeding the market with finished products is what allows it to eventually capture the aftermarket business, which is, as you know, more profitable and which allows us to invest into the future. Going forward, there will always be a healthy level of R&D. Things change continuously, customer demands, legislation for emissions. I think right now there's quite a buzz on autonomous vehicles, and there's a significant pressure towards minimizing the carbon emissions. And all of those require significant R&D, assessing future powertrains, which will in all likelihood be a combination of hydrogen or natural gas or diesel or battery electric. Those things, investing in that is expensive, and you need to do that to remain relevant. I do think together with the autonomous opportunities, we have certainly invested our limited capital quite wisely for the future returns and the future benefits of the Bell Group.
Got a question in my DMs here on competition from cheaper brands. Obviously, my family is actually from a dairy farming background, and you look at tractors on the showroom floor to the local Irish agri market. John Deere is always the most expensive, but there's you get some of the European ones which are that bit cheaper. But I mean, I guess a question on that, and whether they're coming from China or India, or I'm not sure where, but that the cheaper brands competing against the the well-established brands in the market. I mean, how much competition do you see from that, or is it mainly at the margins? Because, as you say, kind of people need the full spectrum of it's the brand plus the aftermarket plus the service, and maybe you get the kit cheaper up front, but you end up in a world of hurt maybe a bit down the road.
Yeah, Mark, I think you're right to some extent. We never lose sight of what our competitors do, and you're right. There's always a host of new cheaper brands, but the initial purchasing cost of capital equipment is only a small portion of the total ownership cost. You look at whether it's fuel burn, whether it's reliability, productivity, uptime. Really, if you're going to buy a production tool, there is no such thing as a cheap solution. You end up paying at some point in time. And what we see with the global growth that we've enjoyed is that it is that mix, as you say, of having a very good product. And good products come at a cost. If you use cheap steel, if you use cheap driveline components, if you really try and just aim for a certain price position, it will haunt you at some point in time. And we've seen it with many of the cheaper brands that arrive on the market, only for a number of years thereafter to be a similar cost in terms of the underlying product. There's obviously price introduction strategies that's temporary of nature, but really you do look at that whole suite, which is the life cycle cost of the product. And then quite critically, which many people ignore, is that residual value of the product. That would make your cost of ownership make or break in terms of the financial viability. You buy a cheap product now, it can't get supported 4 or 5 years from now. The product has no value. You can't use that to reinvest in new kit, in trading it in moving it to other markets. So it is really quite critical that you maintain that balance of the cost of ownership, and that's what we set out to do from the onset with what we offer our customers.
Perfect. Just on, I don't think they're out yet, but we'll be getting the Q3 numbers from Caterpillar and John Deere in the States now, because we're in the middle of a US reporting season. But if I think back to a theme that's been coming through in their reports is, the Internet of Things and connectivity of, their vehicles and trying to almost mirror the Apple model, if I can say that, where there's the hardware component plus a services thing, and they're trying to get another revenue stream going there. Your thoughts on that, and Bell's maybe ambitions to have that kind of hardware software model in some of the newer machines that are coming down the line?
Mark, we've actually always been world leading when it gets to monitoring the product, understanding what our product is doing, the electronic element, as you say, the Internet of Things, that many people like to make it a buzzword, but I mean, we've always been leading in terms of that globally, and even with the autonomous vehicles. So, but you're right. At some point, you have to commercialize everything, otherwise, it's not sustainable. And so we are looking at how do we commercialize these investments that we've made. But obviously, it's always with what's best for the customer in mind, because then you look at sustainable solutions. And I'm just thinking about. We had a phone call earlier today from one of the car tracking companies, and that's an Internet of Thing technology thing. But it's a grudge purchase. I don't really want it because the insurance requires it. But if you look at the solutions that we provide our customers, where the customer can lower his cost of ownership, can prevent accidents, can do preventative maintenance, can enhance productivity, a host of solutions, then at the end of the day, people are comfortable to pay for these electronic subscriptions, as you say, if it is better for them in the long run. So that's definitely the hat we've got on, and how we will approach this. And we believe that's the only way that we will have a sustainable offering to our customers. The autonomous is interesting. There are markets globally where resources are limited. Drivers are becoming very expensive. People are limited. I mean, earlier I've told you about us not getting sufficient people for our German factory. So many of those European markets with an aging population, we do see the benefit of having more electronically controlled, remote controlled vehicles as opposed to fully autonomous, which is, things don't think for themselves. They still need a bit of help. But we need to package that and make sure that our customers benefit from that, and we recover and have a revenue stream from that as well to ensure it's sustainable.
And maybe, just on that, I know, we've got a lot of talk from Tesla about, they're going into the trucks market. But I mean, I think anybody who knows anything about heavy equipment, when you start getting into big machines, the diesel engine has been, there for decades upon decades. That's not to say it can't replace, but, how far away are we from that? An electric ADT that's in the picture behind you there. Just given the energy output that is required compared to the energy output for a small passenger vehicle, if I can say that. I mean, to me, it still seems like the battery technology leap is quite a way away from moving from passenger vehicles into full-on industrial vehicles. Or am I being
no, you're underestimating
the power of engineers these days?
no, don't underestimate. The new technology will surprise us, and will continue to surprise us. But your assessment is correct. I mean, it's one thing to have a passenger car versus a production tool. If you think about the very nature of our product, it needs to carry dirt or something. And we're not going to overcome gravity overnight, so you'll always need a certain amount of energy. And at the end of the day, the more you burden the product with heavy batteries at this stage, the less the payload. So and then there's charging times. So I think the infrastructure lagging, the different technologies being looked at, whether it's hydrogen or gas or combinations, or it means that it's quite open still in terms of what will be the preferred solutions going forward. And in that is also an answer, because it depends. If a town council wants within the city limits only battery, then they would have to pay for that. These things always come at a cost, and the only viable solution that's not impacted or driven by legislation is always economics. If economically it makes sense, people will go in a certain direction technology-wise, but if it doesn't make sense, they won't. If it's legislated and it's forced, then someone at the end of the day pay for it. Where we position, we make sure that we stay abreast of all the new developments. We've got a fantastic team of engineers, and we don't go out reinventing the wheel. We make sure that we partner with first-tier players that understand electric capacity, driveline components, alternative fuels, whether it's hydrogen. And I think the benefit for us there is that we're not married to single solutions like many of the larger OEs which we compete with, where they go off in a direction, they spend billions in terms of R&D, and then they have to make it work, or they have to convince customers, try and sell a concept that may not be the ideal one. So, for us, the benefit there is that we're not absolutely set on a single technology and betting the farm on that. We sort of making sure we will go with the best solution for our customers. And so over the next couple of years, it will be interesting. We're already looking at a time horizon of 2030. So, we're looking 7 years out, what will be either legislated or available. We deal with those big OEMs, and we make sure that we invest in terms of the current product, ensuring its relevance in the years ahead.
I think we've got a couple of minutes left, so I'll squeeze in one more question for me. Obviously, interest costs and debt levels, kind of went up a bit. Some of that, I think, is just, swing from the big working capital swing that we saw due to the inventory numbers. But since you were last here, I think a year ago, interest rates have gone up markedly in the last 12 months. We were in a rising interest rate environment the last time we were here. We are now in a high interest rate environment. And Vic has kind of alluded to it in Calgro's one, their debt levels are at kind of the lowest they've been in a decade. Just from your business, maybe a comment on, from a capital allocation point of view, debt levels, should we see a kind of a focus on paying it down? Are you kind of happy where it is? Just in terms of, balancing that with, investments, R&D, dividends, buybacks, all of that, just in the high interest rate environment we're in at the minute, how you're thinking about it.
Sure, Mark. So, as I said, we're comfortable with where our debt levels are, but we're not necessarily happy. And explaining that the debt levels are directly proportionate to the investment in inventory, which is directly proportionate to our order book and the global opportunity and our growth strategies that we've embarked upon. We should see a normalization in the next 6 months, in the next year. The supply chains got severely jerked post-COVID, or with COVID, and then post-COVID with demand spiking. And we've obviously taken the long view, because we've still got significant growth opportunities globally, that investing in inventory, which is non-perishable, it's sitting with too much inventory at the end of June. I think looking at the finished goods number, there's probably 400 million there, work in progress. So you're probably looking at another 500 to 800 million, which is excess, and which will be worked down in the periods to come, or in the months to come. You know, a couple of ships arrive in South Africa taking a whole lot of finished products, and you should see quite a significant reduction in finished product stock, and then the resultant gearing, or the borrowings. So yeah, it for us, it is always a difficult game. We also mention in the results and in the update, in the slides that I've given you, that moving closer to the markets also means that you are moving closer to the raw materials and the suppliers, and that will also have a significant reduction in working capital. And from a capital allocation perspective, it would mean that more cash would come into the business for other considerations.
Okay, perfect. Leon, I got my 2-minute warning from Deborah Andre there now. So we won't have time to squeeze in another question. But thank you very much for coming back in and giving us an update on all things Bell. And yeah, we'll hopefully have Bell back in at some stage in 2024.
That would be fantastic. Yeah, and thank you very much for the questions, the time. I'm sure there are many other questions. We did put up on the link addresses where you could mail those to, and we're more than happy to engage with the institutional investors.
Okay, perfect. And yeah, if we just move back to the main room now, Deborah will give us some closing comments and highlight our next set of events that are going to be coming up. So I'm going to close this room now, and I'll see you all in the main room.
Thank you.
I think by now everybody should be back in the plenary room, and it's just a time for me now to say thank you very much to everybody who participated in Unlock the Stock today, and a very special thank you to Vickers, Valdi, Sayuri, and Leon for making the time to support this platform and engage with investors. We hope you enjoyed this event, and if you'd like to listen to it again, it will be on the Unlock the Stock YouTube channel soon. We do encourage you to subscribe to this channel for all our latest videos. Please join us for the next Unlock the Stock, a special double session on Thursday the 16th of November with Karoo and TWK, with each company presenting for an hour. So please do look out for that invitation. And that is about it for me, and I hope you all enjoy the rest of your day. Thank you very much.